accounting student. This video clip will be reviewing the accounts payable under the discount term 210 net 30. Let's directly jump into this Excel exercise class work. We already discussed a lot during the class. So that's number 1 question. Does January 5th, the ABC company purchased t-shirts for sales $1,000, which is inventory, the price, on credit with 210 net 30. Again, 2% discount if you pay to the vendor within 10 days. Otherwise, you have to pay the full amount within 30 days. But the company recognized not to fulfill the discount obligation. Okay, when you purchase an inventory, you have to determine that when do you pay? When do you pay? When do you pay? So we need to recognize, based on your determination when you pay, the gross inventory or net inventory. The starting point, if you start recognizing gross inventory, that means that we do not pay within 10 days. But if you start with net inventory, that means we already assume that we'll take the discounted term, so that you record the inventory value considering this discount. So let's record inventory $1,000 on the debit side, and accounts payable $1,000. Now that is the full amount of the inventory. Why? Because the company recognized not to fulfill the discount obligation. So this inventory amount will be the amount. The value will be the value the company will pay. But in 5 years, the January 10th, unexpectedly, the company was able to fulfill the discount obligation and paid the discount cash out amount for the accounts payable. Oh, maybe the company get some cash from the customer or the finance, so that the company can pay within 10 days. So cash out 1,000? No. The company has the discount term, so 980. Then the accounts payable $1,000 removed, even though we pay 980, because the vendor promised you to pay the 2% discount if you pay if the ABC company pay within 10 days. So what account do we need? We start from this inventory is gross, because we didn't assume that we pay within 10 days. We start from gross sales, and then we can use this inventory discount account. So inventory discount. This inventory discount account is contract account that reduce the inventory asset value. That's why we record on the credit side. So $20. Let's link all the journal entry on the balance sheet. The gross inventory, I know we don't have gross inventory there, but at the end of the day, we'll record the inventory net value. So $1,000 inventory gross amount, the January 5th, and then accounts payable, $1,000. So that's it. And the second transaction, accounts payable, we should reduce $1,000 when you pay 980, which is negative. Then inventory discount is contract account that reduce the companion account. So gross amount was $1,000, now minus 20. This account is contract account. That's contract account of asset. That's why we record it on the credit side. Then let's check up if the balance, the total asset is equal to liability and equity. We don't have any transaction related to the net, the income statement. So the retained earning also 0. It's nothing. We can just ignore. So that's it. The second case is also accounts payable. We have the same case, but the ABC company is sure to fulfill the discount obligation to get discount. Maybe the company has enough cash to pay within 10 days. Okay, so in that case, the company can record inventory, maybe inventory, which is a net amount directly. So $1,000 times 98%, considering 2% discount, is the starting point, 980. And then accounts payable, 980. Then clock is ticking from the January 5th. Now the January 15th. In order to get the 2% discount, the company should pay. But unexpectedly, the company doesn't have enough cash to pay the vendor, so the company could not fulfill the discount obligation. Do you have any transaction? No. So the answer is no entry. There's no entry. But when they pay like 26 days later, forfeiting the discount term to 10 at 30, then how much do they have to pay? That's right, $1,000. Correct answer. Then accounts payable. Now, if you put $1,000, we have a problem because when you pay $1,000 and then in order to match the debit and credit, let's put just simply 1,000. It doesn't make sense. How much you recorded? The cash to pay amount, which is accounts payable, 980. By paying $1,000, 980 from your liability should be reduced. If you put accounts payable $1,000, and then the accounts payable will be negative 1,000, negative $20. It doesn't make sense. Okay, so do we record what amount? 980. Correct. So what account do we need? We already started from inventory, net inventory. That means that we cannot go back to the gross inventory. So inevitably, you use other expense account, which is a discount forfeit. Discount forfeit means the company pays more money than $980 they expected. So $20 is the other expense account, other expense. Let's link this journal entry on the balance sheet and income statement. Inventory net amount, we started at the bottom, so we don't consider any inventory discount or the gross inventory. Then accounts payable, 980. So matched out. No entry, January 15th. At the end of the January, now accounts payable cash out $1,000, negative $1,000. And then accounts payable now minus 980. Again, if we had $1,000 accounts payable matching the cash, then what would happen? Accounts payable negative. It doesn't make sense. Anyway, by paying $1,000, we don't owe any amount of obligation. Even we don't have to get, we don't have any right to receive cash, which is a negative liability. So it doesn't make sense. It should be the same as the accounts payable, 980 we previously recorded. Then other expense is negative because it is expense. It should be linked to the retained earning accumulated. Then let's make it sure that if the total asset is equal to the total liability plus equity plus 980. We don't have any the accounts payable, so we matched out. Okay, I wanted to practice by erasing every cell and then like pretending being in a real test. I want you to perform yourself. Okay, See you the next video clip. Bye bye.